Welcome to the Smart Money Pod, your weekly dose of simple, powerful, and actionable money knowledge. I'm your host, Alex Carter, and today, we're diving into one of the most underrated money-saving tools in America, home loan tax deductions. If you're a homeowner in the U.S. or plan to become one soon, this episode might just save you thousands of dollars in 2025. Sounds too good to be true. It's not. Let's break it down, one smart step at a time. Hook. Your money is slipping through the cracks. Imagine this. You work hard. You pay your bills. You pay your mortgage every single month. But when tax season comes around, you either panic or trust software to autofill what you owe. But did you know you might be overpaying? Uncle Sam, because you didn't check one simple box, because you didn't add one IRS form, because no one told you about Schedule Erini. Let's change that right now. What is a home loan tax deduction? A tax deduction reduces the total income you're taxed on. If your income is $80,000 and you claim $10,000 in deductions, you're only taxed on $70,000. And with home loans, you can deduct mortgage interest, property taxes, mortgage insurance in some cases, points paid when you buy a home, home equity loan interest, if used correctly. In short, your house isn't just a shelter, it's a tax-saving machine. Mortgage interest deduction, MIDs. Let's begin with the big one, mortgage interest. In 2025, under current IRS rules, you can deduct interest on mortgage debt up to $750,000 if you filed after December 15, 2017. If your loan is older, the cap is $1 million. Applies to first and second homes. Example. Let's say you pay $1,200 per month in mortgage interest equals $14,400 per year. If you're in the 24% tax bracket, you could save over $3,400 in taxes just from this deduction. Property tax deduction. You can also deduct the state and local property taxes, but with a catch. There's a limit, the SALT cap. State and local tax limits your deduction to $10,000 per year, $5,000 if married filing separately. Still, that's a big win, especially in states with high property tax like New York, New Jersey, or California. Mortgage insurance deduction. Did you put down less than 20% when buying? You're likely paying private mortgage insurance, PMI. Good news, as of 2025, PMI is still tax deductible. For households under certain income levels, typically below $100,000, $109,000 adjusted gross income. Check IRS Form 1098 from your lender. It shows the exact deductible amount. So if you paid points when buying or refinancing to get a lower interest rate, you can deduct those points as well, either in the year you paid or over the life of the loan. Think of points as prepaid interest. They're deductible too. Home equity loan interest. Here's where it gets tricky. Home equity loan, HELOC interest is only deductible if the money was used to buy, build, or improve your home. So remodeling your kitchen equals deductible. Paying off credit card debt equals not deductible. Itemized deductions versus standard deduction. To claim all these benefits, you must itemize your deductions on a Schedule A of IRS Form 1040. But many people just take the standard deduction. In 2025, $14,600 for single filers, $29,200 for married couples filing jointly. So if your total deductions, home interest plus property taxes plus other deductions, are less than that, standard may still be better, but already with home ownership, many cross that threshold. Real-life case study. Let's meet Lisa, a 34-year-old teacher in Ohio. First-time homeowner. $290,000 home. Pays $9,000 in mortgage interest. $5,000 in property tax. $1,200 in mortgage insurance. Total equals $15,200 in potential deductions. Lisa itemizes. She saves roughly $3,600 on taxes. And that's just year one. Common mistakes to avoid. 1. Not saving Form 1098 from your lender. 2. Forgetting about property taxes in escrow. 3. Claiming HELOC interest when not eligible. 4th, double deducting points. 5. Claiming insurance premiums incorrectly. Stay organized. Use software or a tax pro. Tools you can use. TurboTax, H&R Block, TaxSlayer for DIY. Nolo and Smart Asset for calculators and deduction estimators. IRS.gov for official guidelines in Form 1040 plus Schedule A. State-specific tips. Some states offer additional homeowner tax relief. California, Mortgage Credit Certificate, MCC. New York, Star Property Tax Credit. Texas, Homestead exemptions reduce tax bills. Florida, Save Our Homes Cap. Always check your state's revenue department. 1. Standard deduction increased due to inflation adjustment. 2 PMI deduction still alive for most middle-income filers. 3. Some states considering raising the SALT cap. How to work with a tax pro. Ask if they specialize in real estate. Bring Form 1098, closing disclosures, property tax bills. Be proactive, not reactive. Owning a home is more than just building equity. It's building leverage. Kaji, use every IRS advantage you can, because if you don't, someone else will. If this episode helped you, do 3 quick things. 1. Follow the Smart Money Pod for weekly financial deep dives. 2. Share this with someone who just bought a home. 3. Check the link in the description. We've included a free checklist. Top 7 homeowner tax hacks you're probably missing. Until next time, I'm Alex Carter, reminding you, it's not about how much you